Hello, I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, Wall Street is cautious. Fed Chair Jerome Powell's hawkish tone left the door open to another rate hike. Investors currently regrouping after those comments and a notably weak auction of benchmark 30-year bonds. Also, US CPI being eyed. This is the key event next week, key economic event. Investors looking to this for more cues on the future path of US interest rates. If we get a hot number, this could be a shot across the bow for the Fed. And a retail roundup ahead of Black Friday and Cyber Monday and Singles Day. A look at which retail stocks will do better than others. Good afternoon to you. This is the new edition of Beat the Street with me, Angeline Ong. Not long now before Wall Street starts trading. Let's take a look at volatility first after JP's comments. And it just still seems quite stable there at around 1637. Also, Powell's comments coming at a time when many investors out there were not discounting the fact that he could leave interest rates, that potential hike, leave that door open, because inflation still remains sticky and still very, very high, relatively, that is to speak. However, it must be said that the US economy still remains resilient. Here's a look at the S&P 500, the Dow Industrials first, trading around 33,983 there, coming off just a touch, but not much really. Taking a look at the S&P 500 now, which is called the US 500 on the IG platform, a similar story there. As I mentioned earlier, the US economy has been very resilient given the headwinds of inflation and also that cost of living crisis, growth, payrolls, inflation. They're all pointing to the same direction, to an economy that seems to be re-accelerating as opposed to going the other way. Traders now pricing in around a 60% chance of a rate cut by the Fed at the June meeting, compared with expectations of a cut in May before Powell spoke. This is according to the CME's Fed Watch tool. Now, we could get more cues later this session as to where the thinking for the Fed might be heading, because we have the University of Michigan's Consumer Sentiment Index. It's likely to show a preliminary reading of 63.7 in November compared to a reading of 63.8 in October. Ahead of all that, and also the fact that the S&P and the Nasdaq snapped their longest winning streak in 2 years in the previous session, Axel Rudolph, this is one of our IG analysts, has been taking a look at what the technicals say about the Nasdaq.
Well, Angeline, I thought today I'd have a look at the Nasdaq 100 because it's technically really, really interesting at the moment. And you can see here on the daily chart that we've risen by about 9% from the October low in a very swift fashion. I think last week we had the steepest 1 week rise since the beginning of the year. And that took us to the mid-October high, which is technically important because if we can have a daily chart close above that high, we could then basically confirm that bottoming formation, which could then lead us to head back up again towards the psychological 16,000 area. But we haven't seen a daily chart close yet. We've tried several times this week since Tuesday. And then yesterday, obviously, the slightly hawkish comments by the Fed Chair Jerome Powell put a spanner in the works by leaving the door open for a potential rate hike in December. And on that news, and also the weaker than expected 30-year bond auction basically pushing yields up in the US, we had equities come off again. So it's normal for a market to basically consolidate somewhat, especially towards the end of the week when investors have made quite a lot of money in such a short space of time. So what we're seeing here is totally normal. And what will be interesting to see next week is where we can level out with regards to the Nasdaq 100. And then, as I said, once we can rise above the mid-October highs here at 15,339 and close above that level, and ideally also above this week's high at 15,386, then there would be some technical confirmation for further upside to be seen into the year end and perhaps take us all the way back up again towards the July high and the psychological 16,000 mark.
Thanks very much, Axel. Now, for those of you who weren't aware of exactly what Powell said, he said that the Fed is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. He said, "We are not confident that we have achieved such a stance," and added that if it becomes appropriate to tighten policy further, they would not hesitate to do so. Now, these comments, just looking at the US dollar basket here, were considered hawkish by the markets, as you heard Axel mentioning earlier, and gave a boost to the dollar. Longer term bond yields also rising. And according to a poll by Reuters done between the 3rd and 9th November, before these latest comments by Powell, 86% of economists believe that the Fed was now done with hiking and would hold its federal funds rate steady through most of the first half of next year. But they agree on one point with the chairman. They do not expect any measure of inflation, headline CPI, core CPI, PCE, to fall below the Fed's 2% target until at least 2025. Also, I read with great interest, I saw somewhere that the annual Medicare care adjustment is expected to be between 0.4% and 0.6%. Now, this means, if that is correct, that the overall CPI print for November is likely to be between 0.2% and 0.4% higher than it would have been without this adjustment. Now, just taking a look at some mega cap growth stocks for you, just to see if there's been any reaction post Powell's comments. This is a look at Tesla. This is the hourly chart for you. Let's take a look at the daily chart, because this is all sessions on the IG platform. Very little in terms of a reaction there. In fact, it is pretty much up around 0.5% at the moment. Let's check Nvidia as well. Another big cap growth stock that is all sessions on the IG platform. It is climbing around 1% as we speak. And last but not least, let's have a look at Alphabet, parent of Google, of course. Alphabet very, as you can see here, very, very vulnerable or sensitive to any kind of rate discussions by the Fed. It's just up ever so slightly there. And also wanting to check on some other stocks to watch as well. Plug Power, also all sessions there. Its shares, as you can see here, down. Look at that. It's down 16.5%, missing third quarter revenue estimates. United Software, or Unity Software rather, is another one that missed expectations. That's not all sessions, but you can trade that on the IG platform. And Illumina is one other that we are watching for you ahead of the open, because the genetic testing company is perhaps indicated lower because it cut its annual profit forecast for the second straight quarter due to weakness in demand for its sequencing instruments, consumables, and services. Now, to a sector that is going to dominate headlines in the next few weeks, retail. Black Friday and the countdown to that, and Cyber Monday and Singles Day has started. Black Friday, of course, is the day after Thanksgiving, when retailers traditionally would be in the black for the year. So which retail stocks are likely to do well? Well, I've been looking at that for you. Forecasts already pointing to the slowest holiday sales growth in 5 years. This is according to the National Retail Federation. The NRF also said that holiday sales, including e-commerce and non-store sales, will rise between 3 and 4% to $957 billion and $967 billion in November and December. That's down from more than 5% rise last year and a 12.7% increase the year before. No surprise, really, given the hot inflation, high energy prices, which has forced Americans to think twice before splurging.
Upcoming earnings from Walmart, Target, TJX companies, and the like are going to set the tone for the holiday shopping season. But I continue to think that consumers will pivot towards discount retailers like Costco, and especially to digital shopping, which is why I continue to like the shares of Amazon.
That's Chris Versace, CIO at Tematica, talking retailers' anecdotal evidence already that bricks and mortar retailers won't do as well. Walmart and Macy's have seen fewer customers visiting their stores. Just bring up Walmart's chart for you, which is all sessions. Let me just get the right one. That wasn't the all sessions one. There you go. That's all sessions on the IG platform, and it has been progressively climbing higher since around the March period. Don't forget, Macy's also coming out saying they've seen fewer customers visiting their stores despite putting out those discounts early again. Early promotions at Target, Walmart, and Kohl's hasn't boosted footfall either, according to Placer AI. Now, unseasonably warm weather has already had an impact too. It's kept people away from stores for longer, whereas these retailers want them to head into stores and drink those lattes whilst they're shopping. Meanwhile, US online holiday sales, as you heard Chris Versace earlier say, they're likely to jump almost 5% year on year, says Adobe. And driving it, well, more people will be using the buy now, pay later method. So if you're going to pick retail this coming shopping season, choose those with a slick online operation with delay payment operations. Before we go, let's have a last look at how the market is doing. As I mentioned earlier, a lot of caution out there after JP's comments, his hawkish comments, which left the door open to another rate hike. And just checking in on the volatility index for you as well, hovering around that 16 mark. And that's it for this edition of Beat the Street, the show that gives you all the trading action ahead of the open. For more trading insight, do follow me on @IGCom and @Angeline Ong on Twitter. Until then, have a good weekend. This is IGTV.